Investors are continuing to pull away from ESG funds amid growing concerns about a recession. Sustainable funds saw $15 billion in net outflows in the second quarter, according to data from Refinitiv. That was the fifth straight quarter of declines. That all coincided with the increasing politicization of ESG. BlackRock's Larry Fink, the world's largest asset manager, recently saying he's no longer using that term because, in his words, it's been weaponized. Joining us now is Tariq Fancy. He is BlackRock's first CIO for sustainable investing. Tariq, we've had this conversation about ESG before, but now that we have seen the political backlash, I'm curious how you've been watching it. Why do you think ESG, these funds, got to become so politicized? Like, how do we get to this point?
I think the way we have to think about it is to remember that ESG is practiced. It pretended to be about investing, but in reality, it was about marketing and PR, right? If it was really what ESG advocates were saying, which is that we have a bunch of new data that's going to unlock additional returns, I don't think it would get politicized because it'd be fairly objective. And, frankly, Republicans like making money too. But the reality is most of what actually constituted ESG were marketing and PR strategies. Think of a firm like BlackRock. Most of the assets are passive. So, you have marketing and sort of distribution teams driving it, and they find, a bunch of areas that probably aren't that linked to return, but they do sell very well with progressives. And that way, if you kind of look at ESG funds, you'll find that the thesis almost always aligns with one side of the political aisle. Right. So E can be objective, but a lot of S issues in ESG are not. And you'll never find an ESG fund that says, diversity is not good for returns, even if there's evidence to say that, because at its core, it's kind of a price segmentation strategy to address progressives. And it grew during the Trump era when progressives were looking for ways to use their dollars to make a difference.
Yeah, I mean, so much of the concerns were about the guidelines for determining what is E, what is S, and what is G. You've talked before about the promise of ESG. You make the world a better place, you get better returns, and then asset managers get more in fees. Now that those returns aren't good, is there a case for investing in ESG right now?
There's not in its current form. There is in a reconstituted form. So the way to think about it is if this actually started with investors, there's no way that they would mash together a whole bunch of things that are unrelated and into one single score of uncertain weighting with some of them hard to measure. You just wouldn't do that because, frankly, the underlying data is more important. And so I think what we've at a place now where ESG as an industry has produced some good things, right? There's a lot of passionate people around it who understand these things well. There's better data, there's better reporting and standards, but it needs to get to a place where we're actually focused on investing first and not marketing. And if you actually look, there are a lot of areas where businesses can actually become far more efficient. They can optimize their uses of inputs. They can implement reuse economy approaches and frankly, just, get more out of less that are inherently green, right? They improve profits and they also reduce their environmental footprint. And those are not politicized at all. But, I think that's where ESG, probably not to be called ESG anymore, is going to move. And I think, there's a lot of interesting strategies in that area. But I think the historical ESG, where you just take a grab bag of stuff that progressives care about and you try to sell it to them, and its corollary now, which a bunch of anti-ESG funds being sold to the right, those don't produce any investing value. That's just a price segmentation strategy for commoditized products. And we're unfortunately seeing that, happen across commoditized products in the US today because political polarization is so high that there's a Starbucks and then there's Black Rifle Coffee on the right, which adds a machine gun in its logo. It doesn't really help anyone, right? But it does give an opportunity for companies to exploit that polarization so they can sell, commodity products.
It feels like the problem has also been so much of ESG has been conflated with actual climate action. And those are two very separate things. If we're talking about the E, the environmental concerns specifically, are capital markets an effective tool in creating change on that level?
I think capital markets and capitalism are by far the best sort of mechanisms we have to address these challenges. I think the question is how that comes about. The markets need signals from government in order to change their incentives in the way they value the natural environment. So, for example, if we have a tax on pollution, right, which someone won a Nobel Prize in 2018 for saying, and that's based on work from the last century, that gives a signal to markets so more capital goes to renewable resource and other things. And so I think the question is that the markets can do what we want them to do, but they can't do what we want them to do if there's a market failure and we ignore that it exists. And I think a lot of Wall Street is afraid that actually addressing these problems means taking an economic system that is far too focused on the short term and making it actually care about not exploiting the environment in the short term, not doing a whole bunch of things that are not in the public interest. And I think that can happen. But, I think we need to have a more honest conversation about what it entails, because it's not at all uncapitalist to say that, markets need rules to change incentives any more than it would be to say that, is it anti-basketball to say that we need to have referees, enforcing rules? Not really.
So how do you ultimately create impact through investing? If you are an investor, it is about trying to reduce emissions. It's trying to address the concerns about climate change. How do you do that through investing, and how do you measure the impact?
I think, it's an interesting question. I think that you can either do it through private investment vehicles that, by definition, provide fresh funding to innovators. So a lot of climate tech VCs and impact PE firms can actually claim that they're creating impact that would not have otherwise existed. In the public markets, it's much more dubious, right? The original mechanism was that you divest. I mean, divestment is a waste of everyone's time. It's cancel culture meets financial markets. It doesn't change anything. Now people are talking about engagement, right? But the reality is, I started my career as an activist investor. I mean, I worked for and learned to invest in Carl Icahn's former CIO. Activist investing in the public markets can drive change faster than it would otherwise occur. And that's what is called additionality or impact. But for the most part, your question is a good one, because most of what's happening in public markets, you're not actually changing anything that was already going on. And the illusion that we may be is actually concerning, because it is justified a bunch of fee bumps that don't need to exist. And it's also, wasting precious time.
What we have seen in public markets is this push for additional disclosures around climate impact, whether that is about a bank and where they're investing, whether it's about disclosing the vulnerability of supply chains. I mean, I know when we've spoken in the past, it sounded like you weren't exactly, not necessarily on board, but you didn't think that was an effective thing to target. I mean, I'm curious how your thought process has evolved around disclosures, and should companies be forced to disclose more?
I think in general, if there are material areas to a business, whether it's ones that we care about politically or not, but that could actually affect the value of that business, then I think it does make sense to have them disclose it, because any reasonable investor, Democrat, Republican, or otherwise, would need that information. But I do think that there's a concern I have that focusing on disclosure alone doesn't actually change the system. Right? Transparency is necessary, but not sufficient, because ultimately a lot of the exploitation that's going on of the environment is because the incentives are to do that. So if all you do is you have greater disclosure, and now we see who the worst emitters are, does that change anything? I mean, the worst ones will face some public pressure. If they don't have a consumer-facing brand, they might go private. They'll get bought by, someone. I mean, there's actually news stories of some guy, Czechoslovakian guy, who seems to have created a fortune of 17 billion from buying dirty assets that are being sold by public and other players. And so disclosure is useful, but it's not enough on its own, because just seeing that there's something going on that you don't want to go on is not the same as regulating it or changing the underlying incentives, right? Again, if this was a sport, we want to disincentivize dirty play, but disclosures like adding video-assisted referee, or VAR, right, what they call in European soccer, because you can see what's happening in slow motion clearly, but you still need a referee to give out a red card, right? And that's the piece where we can't seem to get past where we are, because the politicians don't seem to understand how to actually enforce sacrifice and get reelected. And they're kind of pushing the ball over to saying, oh, Larry Fink and Jamie Dimon have got this, and they clearly don't have any particular answer, that aligns with the public interest. And I think the sooner we recognize that, the better.
No question, it's going to be an ongoing conversation. Tariq Fancy, always good to have you on, founder of the Rumie Initiative and also former CIO for sustainable investing at BlackRock.